Market expert Nipun Mehta joins in. Nipun, first your word on SBI and whether or not we can see outperformance from this particular bank. Given the kind of gloomy scenario, the numbers haven't looked bad, especially on the NPA front.
Sure, I think the SBI results were definitely above expectations and fairly significantly so in terms of the PAT that the bank has announced. Clearly coming out of the fact that there is lower provisioning that is there. I think what's critical is when one compares this with all the provisioning that the bank did over the last 3 or 4 quarters, very clearly that's been the positive as far as this quarter is concerned. But I think what's critical again is for the next 2 or 3 quarters when a lot of corporates are going through debt restructuring, when there is pressure in terms of margins because of the rupee depreciation, where a lot of businesses which are particularly dependent on imports are likely to face a bit of margin pressure, could have significant dent in profitability. A lot of those companies, whether they would go in for further debt restructuring or no, what's the impact that has, that kind of structuring has on the provisioning that will be there, particularly for the mid-sized banks and also for state banks. So I think for the subsequent 2 quarters or so, it will be critical to watch what kind of provisioning State Bank has. If it doesn't, if it sails through the next couple of quarters, I think you're going to see a significant upside as far as profitability is concerned for SBI, given the improved asset quality that seems to have been there for this quarter.
Right. But Nipun, from a sectoral point of view, would your bias in the banking space still be towards private banking stocks?
Sure. I think there is a good case for looking at the larger banks. There's a good case for looking at the private sector banks. I think we've very clearly seen improved asset quality, better capital adequacy that is there in terms of the revenue mix, whether it's treasury income or the interest margins that are there, or the fee-based income that most private sector banks seem to be gradually increasing upon. You are seeing better revenue management that's happening in order to ensure that difficult times, or in case the credit uptick doesn't really happen to the extent that it is expected, you'll have alternate revenue sources that are there which will ensure that margins are maintained or overall profitability is maintained. So I think it probably might not be the best case to look at the mid-sized banks where there could be, as I said, debt restructuring which could ensure higher provisioning. But at least for the large-sized banks and the private sector banks, there's a good case to take exposure.
Nipun, what about the auto basket? I mean, ever since we've seen the April monthly sales data come in, some of these stocks have really taken a hammering. For example, Tata Motors. Yesterday, we saw a whole lot of confusion and disappointment with regards to Bajaj Auto's numbers as well. What is your call? And are you bullish on any names from the auto pack?
Well, all the numbers haven't really been that bad. If you look at the March quarterly results that came out, or if you look at the annual results that came out, even the Bajaj Auto results weren't really too bad. But I think what's really acting as a concern as far as markets are concerned is the fact that while in the March month there were significant volumes that you saw, both in the 2-wheeler and 4-wheeler segment, and that was for a reason why you saw higher volumes. Clearly coming out of higher taxation, expectation of higher taxation, as well as in certain cases a lot of the sales or stock being at the dealers level, and dealers go down as opposed to the company pushing it off their books. So you saw higher volumes as far as March were concerned. April, obviously, there was expected to be a dent, and that's where we've seen lower volumes. Going forward, again, May and June, you might not see the same kind of volumes that are there both for the 2-wheeler and 4-wheeler segment, given the higher interest rates that are there, as well as the dampening sentiment as far as the entire economy is concerned. So there could be concerns going forward in terms of maintaining volumes that you saw in January, February, March of the current calendar year. You might not probably see the same kind of volumes happening for April, May, June, and that's where the concern really lies for the entire segment. I think in terms of favorites, very clearly, again, whether it's Tata Motors or Hero MotoCorp, they remain favorites for this entire sector in the two-wheeler and the four-wheeler space. There could be concerns, like I said, for this quarter, but for the entire year, if you look at it, given the lower operational cost or raw material cost that you're gradually seeing, you might not see too much of pressure on margins, both on the two-wheeler and four-wheeler segment. So these two market leaders would continue to be favorites as far as this auto space is concerned.
Nipun, what about the FMCG pack? Because obviously in a weak market they come into play as defensives, and also now with commodity costs falling, it's quite likely that input costs will also come down for a lot of these FMCG companies. How would you play the FMCG sector?
Well, on the one side, costs definitely are gradually coming down, so margins might not be under pressure for this financial year. At the same time, there just could be a blip in demand if there is an expectation that the economy is likely to slow down. You could just see some marginal slowdown in certain segments of spending for the FMCG. When you look at valuations, well, they've largely become defensive plays, and valuations look exceedingly stretched when you compare them with a lot of the other valuations when either the mid-cap stocks or some of the large-cap stocks that are there in other segments where valuations look extremely attractive. So in comparison to them, you are seeing fairly stretched valuations. However, I think they just could be some of the larger ones, the HULs and the ITCs of this world might just be favored stocks being defensive stocks despite the high valuations. But in terms of performance, I think very clearly there might not be significant growth coming out of for financial year 12-13, but probably in terms of margins and profitability, I think the entire space would continue to maintain the higher margins and the profitability that they've shown for 11-12.
Nipun, what about the IT space? Do you think the currency trade, given the weakness that we've currently seen in the INR, could augur well in the short term? Or do you think concerns about the European as well as the Western world and the kind of degrowth that we're seeing there are in any case going to batter down the companies?
I think the degrowth is a bigger concern. Very clearly, the extent of spend that a lot of the European clients or the US clients might have, or reduced spend that they might have, is definitely going to act as a dampener as far as the entire IT space is concerned. As far as the rupee depreciation is concerned, we must appreciate that while most companies in a volatile currency scenario would typically hedge their position, that but to a limited extent. They won't hedge it to for a 20% depreciation in the rupee that we've really seen over the last 3 to 4 months. So that kind of hedging isn't necessarily done, but yes, a degree of hedging is, so the company does lose out to some extent on the incremental depreciation that has happened in the rupee if they've done a limited hedging that is there. So there might not be a significant benefit coming out of the rupee devaluation that we've seen. At the same time, there could be client reduced order pressures that could be there. So while the IT space doesn't look too negative, that could be a market performer. I might not bet on the entire space maintaining the kind of profitability that we've seen for 12-13, at least for some of the companies that that we saw for 11-12, the profitability that we saw might not necessarily be maintained.